Welcome back to the Deep Dive. Today, we are strapping in, really, for a close look at the solar energy industry. It's an industry defined by just massive growth, necessary growth, obviously. We all see the headlines, right? Clean energy booming, hardware costs dropping like a rock, global capacity surging. But underneath all that success, there's this huge systemic inefficiency. It's like a hidden friction point, a multi-billion-euro tax, you could almost call it, on the whole solar ecosystem. And it's artificially inflating costs acting as a brake on the whole transition.
Yeah, and that structural problem, that impediment, which we're calling the confidence gap for this discussion, that's exactly what our source material today digs into. We've pulled together a pretty impressive stack of data, actually. There's a solid investment thesis, detailed field reports from a major pilot program in India, business plans. Our mission really is to get our heads around how this platform, Bhaskara BluPrint, which seems to be defining a new category, how it plans to fundamentally, re-engineer the economics of solar.
Okay, so this isn't just about shaving a few cents off panels or making simulations a tiny bit better. This deep dive, it sounds like, is about understanding a whole paradigm shift, moving from, I guess, simulation guesswork to verifiable, bankable, actual empirical data. And at the heart of it, you're saying, is this core premise. The industry just suffers from a crippling lack of trust. Trust in the energy forecasts they use for financing projects, for selling to customers.
Exactly. And if you look across all the material, the big takeaway for you, the listener, is that this company seems to have found a way to monetize certainty itself by providing this definitive, verifiable ground truth data layer. They are positioning themselves to unlock billions in value that's basically just being wasted right now because of uncertainty. So maybe let's start by setting the financial stakes. Just how big is this confidence gap?
Yeah, we really need to properly frame the scale of this inefficiency. The global solar industry is huge, massive, but the sources we looked at really hammer home its Achilles heel, this widespread lack of confidence in energy forecasts. And this isn't just like a vague feeling, it's quantifiable. It leads to spending over $5 billion annually globally just on pre-sale stuff, redundant engineering, dragging out customer acquisition.
Wow, $5 billion.
So,
That's enormous. That's capital that could be building actual solar farms, right? But instead, it's going into managing ambiguity. That's a great way to put it, managing ambiguity. And it acts like this invisible drag chute on the whole sector. And this $5 billion waste stream, it's mostly tied to what the industry now calls the soft cost crisis.
Yes, the soft costs. Everyone focuses on the price of the panels, the hardware coming down. But the non-hardware stuff, sales, marketing, getting permits, design work, that often costs more than the panels themselves now, doesn't it?
It absolutely does. The source material is pretty adamant, actually, that this soft cost crisis is now the single biggest roadblock to hitting the speed and scale we need for accelerated solar adoption worldwide. And the friction's particularly bad in, distributed generation, rooftop solar, commercial buildings, where installers are battling hundreds of different local factors.
Right.
And the commercial result of trying to sell something uncertain, it's a really dysfunctional sales funnel.
Dysfunctional is definitely the word. I mean, look at the numbers you pulled out. Industry standard lead conversion rates below 6%, chronically low. Think about that inefficiency. Installers basically need to generate, 17 or more expensive leads just to land one single deal. That's like playing the lottery.
It is. And why? Because the customers, whether it's a homeowner or a company CFO, they get hit with multiple proposals from different vendors, often conflicting, often opaque. It just leads to what the sources call analysis paralysis. They just freeze.
And that paralysis is financially deadly for the installers, I imagine. Sales cycles stretching out to 8 months or more. Trying to manage cash flow and engineering time with that much delay, it must be corrosive.
Financially corrosive, absolutely. But the root cause here is structural. It stems from something the sources call the good enough paradox.
Okay, let's unpack that paradox, because that seems to get right to the core of why this uncertainty exists. Every solar project, fundamentally, it's financed based on an energy yield assessment, right? An EYA. And that assessment uses standard simulation software, PVSys, Aurora Solar, tools like that. They're essential for design, but they have a built-in limitation.
They do. The research confirms it. Even the best, most carefully done simulation models, they consistently carry an average error margin of about 5 to 6% when you compare their prediction to what the system actually produces over time. Now, maybe to a software engineer, 5%. That sounds acceptable, right? good enough, but that's the paradox.
Right. It might be okay engineering, but it's terrible finance. For the bank, for the investor, that 5 to 6% uncertainty band isn't just a rounding error. It's a material financial risk. It's like buying a house and the appraiser says, well, it's worth either $500,000 or maybe $530,000. That's a 6% spread. The bank has to assume the lower number to be safe, right?
That's the perfect analogy. That uncertainty forces every developer, every financial institution underwriting the deal to price in a significant risk premium. It gets baked right into the IRR calculation, the internal rate of return. And often that makes the difference between a project getting funded or just sitting on the shelf. It fundamentally suppresses investment.
So why is this relevant to you, the listener? Whether you're thinking about rooftop solar for your house or you're an investor looking at clean tech, this systemic inefficiency, this cost of the good enough paradox, it's basically a hidden tax on every single project. Residential, utility scale, doesn't matter. It artificially holds back solar's true financial potential, inflates the final cost, and ultimately slows down global adoption. So to remove that tax, we first need to understand why that 5-6% inaccuracy keeps happening. What are the specific sources?
Okay, yeah, let's transition to that. We need to dig into why these models, as essential as they are, consistently bake in this systematic error. It's not random noise. It stems from 4 main limitations that sort of compound each other. The source material rather dramatically calls them the 4 horsemen of inaccuracy.
Right, and it's important to stress, like you said, this isn't really blaming the software itself. It's just acknowledging you can't perfectly model a very specific physical thing using general theoretical inputs.
Exactly. So limitation number 1, meteorological data discrepancies. Every simulation has to start with foundational data sets, things like the NASA Power Database, to understand the site's long-term climate history, sunlight, temperature, etc. The fundamental weakness here is spatial resolution.
Spatial resolution. Okay, break that down. What does coarse spatial resolution actually mean for someone trying to plan a project in, say, a dense city or a hilly area?
It means the data is averaged out over huge distances. A single pixel of satellite data, providing that critical solar resource info, might cover an area of several square kilometers. So the software is averaging sunlight, temperature, atmospheric clarity across this massive area. It completely misses the hyperlocal microclimates. If your specific roof is on the sunny side of a hill, but the satellite pixel averages in the conditions from the shady side too, your forecast is flawed right from the start.
Okay, that makes total sense. It's just too zoomed out. Now, the second limitation, this one sounds almost scarier because it seems entirely preventable. Catastrophic metadata errors. This is a human error, right? Mistakes in setting up the simulation.
Exactly. And the data point here is genuinely shocking. It comes from a 2024 study by NREL, the National Renewable Energy Laboratory. They found just pervasive, significant errors in the project metadata being used out in the field.
Wow, I remember reading that detail in the prep. NREL found that just putting in the wrong mounting configuration, like modeling a simple fixed tilt roof system as if it were some complex ground-mounted tracker that follows the sun, that alone can cause a discrepancy of over 20% in the predicted output.
20%. And simple errors in the panel direction, the azimuth or the tilt angle, those can cause variations over 15%. These aren't tiny tweaks. They are catastrophic input errors. They fundamentally invalidate the entire financial projection.
Yeah, imagine a bank lending money based on an energy yield forecast that's 20% too high. That loan is basically guaranteed to underperform from day one.
Precisely. It just shows how fragile the simulation process can be, which brings us nicely to the third category, unmeasured site-specific variables.
Right. Simulations have to use static, kind of generic assumptions for these really critical, dynamic, local factors. And this is where the errors really pile up, isn't it? Because the real world is messy. It's hyper-specific. Let's start with microshading.
Yeah, we're not talking about shade from a distant mountain here. We mean near shading. A little rooftop vent pipe, a neighbor's new satellite dish, an HVAC unit on the roof next door. These things are often really hard for software to capture accurately, especially if they change after the initial assessment. And the research cited is pretty stark, shading just 1 or 2% of a PV system's surface. Under certain conditions, that can cause a staggering 30 to 50% drop in the total energy generated.
Whoa, 30 to 50% from just 1-2% shade? How does that work?
It's because of how the electricity flows through the panels in series. If one cell is shaded, it can act like a bottleneck, drastically reducing the current for the whole string of panels. It's an electrical architecture issue, making that tiny bit of shade have an outsized impact.
Okay, got it. So tiny shade, huge problem. What's next on the unmeasured list?
The albedo effect. Basically, ground reflectivity. This is becoming way more important now with bifacial modules becoming so popular, the ones that capture sunlight on both sides. To accurately predict how much extra energy you'll get from the backside, you need to know how reflective the ground underneath is. Is it white gravel? Grass? A reflective roof? If you just plug in a generic static number, you'll likely miscalculate the project's true value, often underestimating the gain from the bifacial boost.
Right, especially if the ground changes seasonally, like with snow cover or vegetation growth.
Exactly. And the final one is soiling losses. Dust, dirt, pollen, bird droppings. It's super site-specific, and it changes daily, weekly, seasonally. Trying to model this incredibly dynamic thing as just a fixed annual percentage loss, like, say, 2% per year, that's a huge oversimplification.
Yeah, I can imagine. Some places are way dustier than others.
Massively so. In the real world, especially in dusty, arid places, think India where the pilot was, the Middle East, the U.S. Southwest, actual soiling losses can range from almost nothing, maybe 1%, all the way up to 35%. You can even get daily buildup rates hitting 0.5% in really bad conditions. The variance is enormous, so that generic assumption, it's guaranteed to be wrong for any specific site, adding more noise to that overall 5–6% error margin.
Okay, so when you put it all together, the core satellite data, the potential for huge human input errors, and then the software just guessing at microshading, changing ground reflection, and dynamic dirt, it becomes crystal clear why the industry has just sort of accepted this 5–6% uncertainty tax. It seems unavoidable with the current tools. Unless you introduce a completely new kind of data.
Exactly. If the root problem is flawed data that's too general or just plain wrong or based on theory, then the only real structural solution has to be empirical truth, actual measurement. And this is where the Bhaskara BluPrint platform comes in. They're positioning themselves not as just a better simulation tool, but as this essential physical validation layer, the thing that finally makes those simulations bankable.
That's the core idea. They're not trying to slightly improve the simulation's guess. They're aiming to eliminate the need for guesswork on key variables by establishing a new standard for data accuracy, ground truth. And the solution itself is this tightly integrated stack. It's hardware, software, and data science all fused together, specifically designed to tackle those 4 horsemen of inaccuracy we just talked about.
Okay, let's look at the physical part first. Component 1, the BluPrint device. This is their hardware as a service bit, a portable IoT device you take out to the site.
Precisely. It's a portable smart IoT device built for rapid deployment right there on site. It's the tool that actually captures the ground truth. And the key innovation is how it measures. It doesn't try to model the cause of energy loss, like, say, the exact shape of that HVAC unit causing shade. Instead, it directly measures the effect. It measures the resulting net reduction in usable photons right at that spot, caused by everything combined: the microshading, the current level of soiling, the specific atmospheric clarity at that moment, even reflections.
Ah, okay. So instead of estimating all those complex factors, it just measures the final result. How much sunlight is actually usable for generating power at that exact spot on that exact day. It's a single, integrated, empirical number that software alone just can't get.
You've got it. Now, that high-accuracy, short-term, hyperlocal data, it's incredibly valuable. But solar projects are financed based on 20 to 25-year forecasts, right? So you need to somehow connect that momentary ground truth with the long-term historical climate picture. And that's the job of Component 2, the AI-powered validation engine. This is their core software-as-a-service platform.
Okay, the AI, the sophisticated bridge, as the notes called it, connecting the real-world snapshot to the long-term stats. How does the AI actually do that calibration? It's not just averaging, right?
No, definitely not just averaging. That's where their IP really lies. The AI uses that short-term, high-fidelity ground truth data to establish a site-specific bias correction factor for the established long-term satellite data sets.
A bias correction factor. So, like, if the satellite data for that grid square is consistently 5% too sunny because it's averaging in a brighter area nearby, the AI figures that out for that specific site and then adjusts the whole 20-year historical record accordingly.
That's a key part of it, yes.
Yeah.
And it goes further. The AI also uses machine learning to analyze spatial patterns, frequency patterns. It recognizes local atmospheric stuff like persistent morning fog in a valley or seasonal dust patterns from nearby agriculture, things that generalized data sets completely miss. The end result is a custom-calibrated, statistically solid, long-term weather file that's uniquely tuned to that specific project site. It merges the long-term view with the on-the-ground reality.
And the output of all this, The hardware measurement plus the AI calibration is the bankable report. We mentioned bankable earlier, but let's really stress why that word matters so much in project finance. What does it mean for a report to be bankable?
It means everything in that world. It means the report meets the incredibly high standards of transparency, rigor, and verifiability that financial institutions demand before they'll lend serious money against it. It's the gold standard for project documents. Essentially, it de-risks the investment significantly. It pulls that projected revenue stream out of that fuzzy 5–6% uncertainty zone and nailed it down.
Right, so this changes the whole dynamic. For the end customer, the homeowner or business, the analysis paralysis potentially goes away. They're not comparing 3 different fuzzy guesses anymore. They have one verifiable forecast based on reality.
Exactly. And for the EPC, the installer, they get instant credibility. They can actually defend their energy projections with real measured evidence. Look, this isn't just a simulation. We measured it. But crucially for the financier, the bank, the report provides this auditable, transparent trail. They can see the underlying data isn't just theory. It's calibrated against actual site conditions. That leads to higher loan approval rates, better financing terms. Everything flows from that trust. They're essentially selling certainty. And in finance, certainty is probably the most valuable commodity there is.
Okay, the tech sounds really compelling, the logic holds up, but the real proof is always in the pudding, right? The field validation. And this is where the source material gets really powerful, detailing the results from that big pilot program in Gujarat, India. This wasn't some small lab test. It involved, 100 different EPCs? Over 1,200 separate site assessments across all sorts of real-world conditions. That sounds robust.
The rigor is absolutely key here. It gives us high confidence in the conclusions. And the quantitative results weren't just, incrementally better. They showed a complete transformation of the sales and engineering process. Let's start with maybe the most jaw-dropping metric, sales cycle compression.
Right. This is about business velocity. How fast can they close deals? The data showed the average sales cycle time was slashed by 61.4%. That's huge. The industry standard is that painful 8 months or so, around 252 days. This pilot got it down to roughly 3 months, 97 days.
That kind of speed is a total game changer for an EPC's operations. It dramatically improves their operating leverage. Instead of waiting 8 months to get paid, they're closing in 3. It means the same sales team, the same engineers, can handle basically 2.6 times the project volume without adding more staff. That flows straight to the bottom line. Pure margin amplification.
Okay, speed is one thing. But the metric that really speaks to closing that confidence gap we talked about, that's lead conversion enhancement, right? Before using this platform, those EPCs in the pilot were converting leads at that standard industry rate, around 5.6%, pretty low.
Right. And with the BluPrint system, that conversion rate didn't just edge up, it didn't double. It leaped to an absolutely unprecedented 29.8%. We are talking about a nearly 5-fold improvement in how effective their sales efforts were.
5 times. That's incredible. That seems like the clearest possible proof that if you give the customer certainty, that verifiable data, the analysis paralysis just evaporates. They feel confident enough to actually sign the deal.
That's exactly the interpretation from the source material. You shatter that psychological barrier of doubt.
Yeah.
The EPC isn't walking in with just another simulation. They're bringing a certified bankable report that validates the numbers against physical reality.
Yeah.
That trust is what catalyzes the sale.
And the efficiency gains continued on the engineering side too, right? Pre-sales efficiency.
Yes, equally profound. The pilot measured a 68.3% reduction in those expensive engineering hours needed for each proposal. They dropped from an average of 10.4 hours of skilled engineering time per proposal, down to just 3.3 hours.
10 hours of an expensive engineer's time spent on a lead that has a 94% chance of going nowhere. That's just financially brutal. Cutting that by 2/3, that frees up those engineers to work on the actual detailed design for the deals they have won. High-value work. This feels like how the platform directly tackles that soft cost crisis from the resource angle.
Precisely. Now, beyond the hard numbers, the qualitative feedback really backs up the story. User satisfaction was sky high, 86%. And the comments highlighted that immediate credibility boost, especially when talking to the banks, the money lenders.
Yeah, I love that quote you pulled. We got instant credibility with clients. That BluPrint report made the whole process with the money lenders much faster and without any headache. Without any headache, that says it all, doesn't it? It removes friction for everyone involved.
It really does. And that translates into stickiness. When they asked the pilot users if they go back to their old simulation-only methods, a massive 93% said they'd be unlikely or very unlikely to do so. It seems once you've tasted ground truth, going back to pure guesswork just isn't appealing.
That's powerful. And then the final piece of validation, the strategic one, that 10,000 device letter of intent, LOI, from the Gujarat Federation of Solar Industries, that's not just a big order. That's an entire industry body basically saying, yes, we want to adopt this as our new standard way of operating.
Monumental is the right word. That LOI is effectively the blueprint for creating a huge defensible data mode. By getting themselves established as the required data standard for a whole regional industry, they secure this proprietary asset, this growing database of hyperlocal ground truth performance data. And that's something competitors, especially software-only players, will find structurally impossible to replicate. You can't simulate ground truth if you don't have the physical measurement capability deployed at scale.
Okay, so the Gujarat pilot really proves the core value. But the company's long-term vision, according to the sources, rests on this clear two-phase plan. The dual horizon strategy. Horizon 1 is like the thin end of the wedge, attacking the EPC pre-sales market. Get immediate traction, generate high-margin recurring revenue using this trust-as-a-service model.
Exactly. And the business model for Horizon 1 looks really well designed. Low friction to get started, but high recurring revenue potential. It's a blend SaaS plus HaaS. There's a recurring software as a service subscription, around €499 a year typically, covering the platform access, the AI analytics, and then there's a per-use fee for actually doing a hardware assessment on site. The hardware as a service part, around €299 per use. This aligns their revenue directly with the value the EPC gets from each successful assessment.
And the ROI for the EPC, the customer, it seems incredibly clear. The source material broke down the financials for a typical mid-sized EPC aiming for, say, 100 installations a year. Starting from that baseline 6% conversion rate, they need something like 1,667 leads just to hit their target of 100 sales.
Right, a huge amount of effort for those 100 deals. But adopting the Blueprint platform, getting that near 30% conversion rate, it completely changes the math. Suddenly, they only need 345 proposals to secure the same 100 sales. Factor in that massive drop in lead generation needed, plus the 68% cut in engineering hours per proposal. Their total pre-sale soft costs just plummet.
And the impact on their profit. Even after paying for the Blueprint subscription and the per-use fees, the EPC's final net profit on those 100 installations goes up by 105%. Double their profit.
That's the projection based on the pilot data. Double the net profit.
Yeah.
And that is why you see that incredible adoption rate and that 93% stickiness. The platform isn't just a tool, it's a fundamental profit engine for the EPC.
Which explains that key metric underpinning the whole investment case, the projected LTV/SAC ratio, lifetime value to customer acquisition cost. The sources project that at nearly 20 to 1.
Yeah, 20 to 1, which is extraordinary in the SaaS world.
Right. For anyone listening who isn't deep in subscription metrics, usually a 3 to 1 ratio is considered pretty good, healthy. 5 to 1 is seen as great. 20 to 1, that suggests incredibly strong defensibility, very low customer churn, and almost viral efficiency in acquiring customers. What's driving that number?
It's really that combination. The super high conversion rate slashes the customer acquisition cost, those SEEPs. And then the extreme stickiness that 93% who won't switch back drives up the lifetime value, LTV, through reliable, recurring subscription and per-use revenue streams. Yeah. So Horizon 1 looks like this powerful, high-margin, potentially self-funding wedge to get deep into the industry.
Okay, so that's the wedge. Now let's look at Horizon 2. This is the real scale-up play, right? Pivoting to the utility-scale O&M market, operations and maintenance for the really big solar farms. Here, the same core tech evolves. It goes from being a portable tool used before construction to becoming a permanent, high-value platform used after the plant is built to optimize its performance.
Exactly. Think about how O&M often works now on large solar planes. It's frequently reactive. Operators might rely on expensive drone flights with thermal cameras every quarter, maybe, which only captures a snapshot in time. Or manual inspections. Or worse, they wait until a major part fails and output drops significantly before they intervene. This reactive approach means they often miss subtle problems like panels degrading slightly faster than expected, or uneven soiling building up that quietly erode the plant's revenue day by day.
Okay, so the Bhaskara solution flips that. Instead of a portable device, they install a permanent grid of their sensors across the plant, maybe one at each string combiner box or inverter, creating this real-time data map of the entire asset.
That's the concept, a permanent granular real-time data map. And this enables the crucial shift from reactive maintenance to predictive and prescriptive maintenance. The AI engine continuously analyzes performance data right down to the string level. It can spot tiny anomalies, the very first signs that a specific module is starting to underperform, or one section is getting dirtier faster than others, long before a quarterly drone scan would ever catch it.
Ah, so it allows for really targeted, proactive fixes. Go fix that specific string that's showing early issues, instead of sending crews out to manually inspect huge areas or waiting for a major failure. What does that translate to operationally?
The value proposition for the plant owner is huge. The internal models we reviewed suggest the system can cut overall O&M costs by a minimum of 30%, potentially up to 50% in some cases. That comes from maximizing the energy yield by catching problems early, plus massive gains in labor efficiency because the interventions are so targeted.
Let's put a number on that. For a typical 100-megawatt solar plant, the platform is projected to deliver a net annual value gain, combining cost savings and extra energy produced of over $169,000. That drives a really attractive 2.2x ROI just in the first year. Suddenly, this isn't just an O&M cost center, it's a tool for actively maximizing the asset's revenue.
Exactly. And this is where the two horizons connect beautifully in what the sources call the synergistic flywheel. Horizon 1, selling the pre-sales tool to EPCs, naturally feeds Horizon 2, the O&M platform. Every single new solar project that gets sold using the BluPrint pre-sales tool, that becomes a warm lead for installing the permanent O&M solution on that same site later. The EPCs effectively become an embedded sales channel, introducing the higher value enterprise O&M platform to their own clients right from the project's inception. It's a really smart growth loop.
Okay, let's try and quantify the total opportunity here and look at how the company plans to actually execute this transition from Horizon 1 traction to Horizon 2 dominance. We're talking about two enormous growing markets. The EPC pre-sales market, that total addressable market, or TAM, driven by those global solar soft costs, that's valued at over $5 billion a year. Huge.
And the utility O&M TAM, that's defined by the absolutely explosive growth in global solar capacity being built. The company's strategy targets getting their O&M platform deployed across 125 gigawatts of solar capacity within year 3 of commercialization. And remember, that market isn't static. It grows bigger every single day as more solar farms get built around the world.
Right. And the financial roadmap laid out seems to clearly show how blending these two revenue streams creates a believable path to significant scale, aiming for well north of $100 million in annual recurring revenue, or ARR.
Yeah, the ramp-up looks quite deliberate. In year 1, which they project is 2026, the EPC business is the main engine. It drives market entry, gets the brand out there, builds initial revenue, targeting around $15.0 million in ARR from that. The O&M platform starts more selectively, maybe with high-value pilot projects on large plants, distributing about $3.0 million. So total ARR in year 1 around $18.0 million, a solid foundation.
But the big shift happens by year 3, projected as 2028. The EPC business keeps growing strongly, maybe hitting close to $70 million ARR itself. But the utility O&M platform really hits its stride and scales rapidly. It's projected to generate roughly $74.8 million in ARR all by itself by then, becoming the larger revenue stream.
That's the plan, showing that successful strategic pivot. The total blended ARR is projected to hit around $144.7 million by that year 3 mark. So the financial trajectory seems well-defined, moving towards being primarily powered by that higher margin, stickier enterprise O&M market. Of course, hitting numbers like that depends on flawless execution. Which brings us to how mature their product evolution looks.
Yeah, I found this part really telling, actually. It helps de-risk the execution question. They didn't just design this thing in a lab. They used that Gujarat pilot to gather real, sometimes painful feedback from users in the field, and they turned those complaints directly into features for the commercial device.
Absolutely crucial. That Gujarat pilot, remember, was run using a first-gen prototype. Clever, but maybe not ideal. Essentially a repurposed smartphone rigged up with a 5-watt solar sensor kit. It proved the concept, but it definitely had friction points for the technicians using it every day.
Like, users complained the 2-part prototype felt delicate, not very tough. Which makes sense, you wouldn't want something fragile on a busy, dusty construction site.
Right. So the commercial unit that resulted, engineered as a single integrated industrial-grade device. It's got a ruggedized casing, shock-proof, water-resistant. They learned the data has to be reliable, sure, but the thing gathering the data needs to be practically indestructible for field use.
And battery life. That was a constant concern, according to the notes. You can't have technicians worrying about their measurement tool dying halfway through a site assessment.
So the commercial design tackled that head-on. All-day battery life capable of 8 to 10 hours of continuous active field use. No need for fiddling with external power banks. That reduces downtime, boosts efficiency.
And the final big one was connectivity, especially out in rural areas. Users were getting frustrated with sync delays, potentially losing data if the signal dropped.
Yeah, critical issue. The solution: robust offline capabilities. The device can store multiple high-detail assessments internally. Then, whenever it gets back into stable cell range or connect to Wi-Fi, it automatically and reliably uploads all the queued data. This whole iterative process, taking direct field complaints and engineering solutions, it really suggests the commercial product launching is genuinely designed to solve the user's actual daily problems.
And ultimately, all these smart design choices, combined with that strategic LOI from the Industry Federation, it really locks in their long-term competitive advantage. It builds that definitive data moat we keep coming back to.
Because the whole platform relies on physically deploying their patented IoT device to get that unique, hyperlocal, ground truth data. They're building an asset that's structurally protected. Software-only competitors can analyze all the generic weather data they want, they can build slicker interfaces, but they can never replicate the verified site-specific reality that Bhaskara is capturing, physically, at scale. That's the moat. Hashtag check outro. So just to synthesize everything we've covered, we see this really clear, compelling picture emerge. It's built on, 5 key pillars? First, a massive inefficient market bogged down by that multi-billion-dollar confidence gap. Second, a truly transformative solution, proven in the field by those staggering Gujarat pilot results. Third, a highly scalable business model that trust as a service, driving that incredible projected 20-to-1 LTV/CAC ratio. Fourth, a clear, seemingly de-risked path to scale with that dual horizon strategy. And finally, fifth, a really defensible competitive data moat, built on proprietary hardware measuring empirical reality at the site level.
Yeah, it feels like this company is positioning itself not just as another tech vendor in the solar space, but as something more fundamental, like the essential trust infrastructure provider for the whole solar revolution, operating right at that crucial intersection of massive clean energy growth, the Internet of Things, and practical applied AI. It really does feel like a potential disruption.
And that brings us neatly to our final provocative thought for you, the listener, to mull over. If the single biggest bottleneck slowing down solar adoption globally is really the cost of doing business, that multi-billion-dollar cost of trust driven by uncertainty, and if that cost can be dramatically slashed, maybe even eliminated by this kind of verifiable ground truth data, then how much faster could solar adoption really accelerate worldwide? Could it fundamentally change the whole timeline for the energy transition?
And maybe take it one step further. If this soft cost crisis across industries is fundamentally about bad data inputs leading to financial uncertainty, what other huge sectors that currently rely heavily on theoretical models could be next? Think about large-scale infrastructure projects and risk assessment, or forecasting agricultural yields, or even pricing complex insurance policies. Could they also be disrupted by the introduction of empirical, verifiable ground truth validation? Maybe the soft cost crisis and the need for ground truth is only just beginning. Lots to think about there.